What Todd was talking about there is, of course, the full description of the 12 different income methods in the blueprint for the limited risk technique. But as the stocks keep moving up and he's been using income method number 4, he wants to know, is there a certain point where it does not make sense anymore, especially if the stock keeps making higher highs? How do you handle strong momentum stocks? All right. What is income method number 4? Well, it's one of the 12 income methods. They're used against the married put structure we talk about, the radioactive trading technique described in the blueprint. Now, each position starts off as a specific married put position, a stock plus put combination. As the stock moves up, we may look to roll up the put to lower the risk on the trade. Now, this is done at a debit, but the increase we get in the guaranteed exit price is always higher than the debit we pay in. So let's go back to April 1st. This wasn't the low that he was talking about, but I grabbed an example here. On April 1st, 2020, the FNV, Franco-Nevada, was trading at 102.73. As you can see earlier today, it closed at around 141.98. Now, I could have, following the radioactive trading techniques, the best structure I saw was on April 1st. If I bought the stock at 102.73, I also would have bought a January 115 strike put following the rules in the blueprint. Now, this would have given me a cost basis of $12,423 or $124.23 per share. The put guarantees that I'm going to get back $115 even if the stock fell to $40 per share. So my maximum risk is $923 or 7.4% with an unlimited upside profit potential. Okay? Now, the stock has moved up. But before we address where it is today, let's take a look at what might have happened over this trade. Again, April 1st was our trade entry. We bought the 115 put. On around April 13th, the stock gapped up above 115. This would have been a perfect time to do an income method number 4 to roll the 115 up to the 125. Then the stock continued to move up, and on April 23rd, we're trading around 133. This would have been a good time to make a bigger jump from the 125 to the 140 strike. So that would have been our second income method number 4. And the stock continued to move up. So when it gapped up here at 145 on around May 7th, likely would have rolled to the 150 strike in that case, and we would have been here. And now the stock has pulled back since then. Okay, so we would have done 3 income method number 4s likely based on how I'm seeing this chart. Okay. Now, what would the income method number 4s look like? Well, remember the first one, we started off with buying the stock at 102.73 and buying that 115 put for $21.50. On April 13th, the stock was at 121.83. I could have sold to close the 115 put for $14.05. Lost about $7 on the initial put purchase from $21.50 to $14.05, but we've gained roughly $19 on the stock position. It's a fair trade. But I'm going to go ahead and buy the 125 strike on April 13th, moving up in price, staying in the money for a cost of $19.85. The total debit would be $5.85 added to the position. So I increased my cost basis to $13.03. But now I'm guaranteed to get $125 back, so the risk is lowered to 3.9%. I paid a debit. This is one of the only income methods that's done at a debit of $5.85 between these two. And remember, this put price is already factored into that total cost basis, so this adjustment adds an additional $5.85 to our cost basis, but I'm gaining 10 points of higher payout. That's why the risk dropped to $5.03. Okay, so that was the first income method, and this is the outcome. Increase the cost more than increase the guaranteed payouts, which reduces the risk almost by half. Not quite, but almost by half. Okay, now going forward again, our next adjustment probably would have happened on around April 23rd when the stock gapped up to 133.26. At this point, I would have likely sold to close the 125 put we had for $15.90. So we've lost a fair value on that put as well from $19.85. But I'm going to go up more now. See, it's at 133. Instead of just going up 10 points to the 135, I'm going to go deeper in the money to the 140. And that would have been $24. So I'm getting a debit of $810. So our cost basis goes up to $13,813 or $138.13 per share. But we're guaranteed to get $14,000 back, the 140 strike put. So that means we're now bulletproof on the position. We have a higher guaranteed payout than our cost basis. We're at a bulletproof trade, negative 1.4% guaranteed profit, no chance for loss, still infinite upside. I paid a debit of $810, but to gain 15 points of a higher guaranteed exit. Now we're in bulletproof status. But our stock kept going up. And so the next approach, third income method number 3, on May 7th. The stock gapped up to 144.62. We were holding the 140 put. It's now out of the money. I'm going to look to roll it again. Sell to close the 140 put for $17.80. Buy the 150 for $23.60. We have a debit of $5.80. Another cost in, but we're gaining 10 points of guaranteed payout. So our guaranteed profit increases to $600 or 4.2% of bulletproof status. Now, this doesn't answer the question directly, but this gives us a base point of what it would look like doing this position. We started off with an initial cost basis of 102.73 for the stock and 21.50 for the put. We've increased that total cost to 143.93 per share with the stock adjusted cost basis and our current put, but that puts us in a bulletproof status. Now, as we saw, we kept moving up, went from a 7.4 to a 3.9 to a bulletproof status to guaranteed profit of 4.2%, and the stock fell back down. And even if the stock continued to move up, when would we consider to stop using this adjustment and stop adding to our cost basis? Well, the trick there is it comes down to your expectations, your risk threshold, and what you want to accomplish. Here are the 4 positions and where they stand right now. So including the increased cost basis, the original price of 102.73 and 21.50 for the first 115 put. The first roll, on April 13th, we would have an adjusted cost basis of 110.18 and a new cost on the put of 19.85. Of course, you can see here how the put's decaying on each one of these. We lost $1,300 if we did nothing with the original put. If we just did the income method number 4 the first time, we would have lost $9.15 on the put. Then, of course, here's our second roll, new adjusted cost on the stock of 114.13 with a 140 put at 24, so a 138 cost per share, 138.13 cost per share with a 140 put. That's our first bulletproof position. And then the last position with a new adjusted cost basis of 120.33 for the underlying stock and holding a 150 put for 23.60 for guaranteed profit of 4.2%. Where do they stand right now? What was the issue and the effect of using income method number 4? If I left position 1 alone, as it was and did nothing from April 1st, we'd be looking at a 20% profit on the position. Okay? We've gained a large percentage, almost 37%, 35% on the stock alone, but just leaving the put alone as it went out of the money and started to decay more, we lost a fair amount on that put. That first income method number 4 on April 13th going to the 125 put. Right now, that would be a liquidation of 16.1%. We gave up that 3% there for the extra debit we paid into the position. Now on 423, we gave up a couple more percentage, but if we had done the roll on the 23rd to roll the 140 put, left the position that it is right now with the stock at 141, we'd have a 14% return. Going to the 150 didn't really change it too much for us. As the stock pulled back, that would be a liquidation right now of 14.1%. So we gave up 5.3% potential profit that we could be sitting on right now in order to do what? In order to bulletproof to about 4.2%. So remember, even though this position that we rolled up to is only making 14.1%, if the stock continues to reverse and now it drops back down to 133, 124, we're guaranteed a profit of 4.2%, where on these positions we might start be looking at a loss at that time as time decay still goes with us. So it's a trade-off. But when would you stop doing it? And the reason I stopped at this point is not just because the stock stopped moving up, is because this is typically when I might consider stopping. It is up to your goals and your personal risk tolerance. Ernie's approach and my approach is typically after you've bulletproofed a trade to a reasonable return, say maybe 5% guaranteed profit after 2 months or 2.5 months, maybe 3 months. That's a good consideration. You've got the locked-in profit at 5, 6, 7%. They might not need to continue to use income method number 4 after you've already bulletproofed to your minimum goal requirements for the trade. Okay? Now, I have used it to bulletproof a position to a 28% guaranteed profit. That was the silver wheaten position. It ended up being a total profit liquidating the position of 58.9%. I could have had more profit if I stopped at a 10% guaranteed profit. The one reason why I did it up to 28 is the stock kept moving up prior to earnings. It moved from $17 to $40, I think, the time I was holding the trade over a 3.5 month period. And I was coming up to the next earnings, and I figured, why not? I might as well just roll it up again, go from, I think I was at a 14% bulletproof status, went up to a 28. No, it was 21, I'm sorry, 21% bulletproof to 28, because if the earnings disappointed and the stock crashed, I could still make 28% guaranteed return for 3.5 months. Well, it shot up, so I made 58.9. I could have made more without using income method number 4s, but this whole position well exceeded my goals and expectations for radioactive trade. Okay? There is more in-depth information on this. In the beginning of January 2020, we did a Blueprint Owners Q&A session. And if you're a Blueprint owner, you go to radioactivetrading.com. Log on to your free registration account if you're not a Fusion subscriber. But as a Blueprint owner, you just log on to your free registration account, and then you click on the link for Blueprint Owners Only webinars. And you'll see the Blueprint Owners Q&A from January 2020, and right at the 14-minute mark, we essentially say the same things, Todd, because Jim, Nelson, Terry, Kirby, a couple people on YouTube were asking the question of when do you stop using it. So this was about a 15-minute, 16-minute presentation, maybe a little bit more on the same concept, but you can always review that. And of course, we're recording this, and this will be available for Blueprint owners and probably available on YouTube as well. And the ideas and concepts to when to stop using income method number 4. Again, it is up to your goals and your risk tolerance. If you fear a big decline in the market and the stock's still moving up, you fear there might be hesitation in the next month or two, it wouldn't hurt, even if you're already 5% bulletproof, to roll it up again, get up to 8 or 10% bulletproof status. Why not? What's the harm? But a general rule of thumb, if your target return on a married put position over time is to try to target a 6, 7, 8% return on your winners, while keeping your losers to 3 or 4% over time, once you've hit that 5% bulletproof status, that might be a good idea to maybe stop if you're looking for more profit and you don't want to keep adding to the debit, Todd, as well. William, we talked about this a couple weeks ago. I'm going to go back to the married put here. I'm going to go back to the FNV position. I put them all in here. We were looking at it on the graph earlier, but here's all the 4 positions that we were looking at. And just take the original one. There's a couple questions here on income method number 4, and then I've got a covered call question as well. William says, Michael, for a fast-moving stock like FNV that we saw take off, could one consider selling put credit spreads on the way up to collect income and to offset the debit to cost income method number 4? If you're comfortable with the increased risk, yes. Remember, that's not one of the, most of the guidance of the income methods that are discussed in the blueprint are designed to not increase the risk when you enter them, except for one, and that, of course, lowers the cost basis at the same time. We don't like doing income methods. That's why you don't see a lot of things about certain spreads aren't used in the 12 income methods, because it increases the risk to the downside. We don't want to do that. In this case, you could have been right. You could have done bull puts on the way up to offset it if you were still confident it went up. But remember, the last time I did an income method number 4 in the FNV example, we went up to 150. The stock fell about 7 or 8 points shortly after that and is now at 140. So the bull put credit spread might have lost. Not think it would have taken me out of bulletproof status in that case. But again, I just wanted to illustrate that's why it's not one of the income methods, William, because when you do a bull put credit spread, it adds to the risk on the position. So Dan says, is there an issue that you have seen, this is going back to the married put, is there an issue you've seen that's just focusing on income method number 4? Dan has tried using income method number 1, just selling a call, 5 and 6, the riskless spread trades many times, but it seems that I'm terrible at timing those entries and lose money on them at least 50% of the time. I have never had an income method number 4 hurt me. I realize I'm limiting things, but I'm looking to keep it simple. Dan, the real question here is I very rarely, in my trading with RadioActive, I never go into a trade, Dan, ever planning on using one specific income method. I sort of let the movement of the stock dictate to me what I'm going to do. I will be honest and upfront with you, Dan, and you can probably see this from my track record. I'm a fan of using income method number 4 first, once or twice. And when I do the first income method number 4, I might use income method number 1 to offset some of the cost of that debit to roll. And my goal is that once I get bulletproof, now I feel more confident to use income method number 6 or income method number 5. A while back, I did many things a while back, but when we had questions like this come in, the next 3 RadioActive trades I opened as a married put with income method number 6 right away, and none of them worked out to my advantage. They all moved up perfectly between the 2 strike prices, and I use that as an example why I never use income method number 6, the bear call spread, when I suddenly open the married put position. I wait and then look to do it later, okay? So I don't have a study to tell you that, but I think that if you're feeling concerned about it, to keep things simple, you might just want to focus on 4 and 1 at the beginning. Then once you get bulletproof and you've got a little bit more confidence in that, you've got a little bit more strong feeling now that you've lowered the risk, maybe then it's okay to start playing with a little bit of those positions.